Hi everyone, welcome to another video by Stock Trades. Today, we're going to do something a little bit different. We are answering subscriber questions. Questions like, are you about to enter another stock market crash? My name is Matt. I'll answer this question and more right after this. Today's Q&A session is a first for us on our YouTube channel. Our Q&A section on our Stock Trade Premium site is one of the most active components of our site. People tend to appreciate our insights and opinions on the stock markets in general and individual stocks. So today, we decided to give our YouTube subs a taste of what that looks like. The first question comes from Trevor Reed. He appears to be a younger investor and is struggling between adopting a dividend growth strategy or going strictly with a growth strategy, and how that might look, especially if he wants to build income in retirement. It's a great question and one that many investors ask themselves. Let me read a couple of snippets from his question. Would it be more beneficial to stick to a growth solution and then transferring that money into dividend-paying stocks when income is required, or go straight up to dividend growth from the get-go? It's a great question, and it is one that is near and dear to my heart. One of the common misconceptions is that one has to sacrifice growth if they adopt an income investing strategy. That's not true. There are several stocks that offer both an attractive yield and the potential for outsized growth. Let's take a couple of examples. OpenText, which is one of the premier dividend growth stocks in the technology industry. OpenText, over the past 10 years, has returned approximately 500% to shareholders. On top of that, it has averaged 15% dividend growth over this time. It is only one of 4 Canadian dividend aristocrats that are in the tech industry. This is a perfect example how a young investor can marry dividend income and growth at the same time. You might be surprised to know that you can also get some pretty considerable growth from high quality blue chip companies. Case in point, Fortis, which is one of my favorite utility companies and one which I've been long for more than a decade. Over the past 10 years, Fortis has returned approximately 80% in share price. When you add the dividend on top of that, a dividend which has been growing at approximately 6% annually, Fortis has returned almost 169%. In total, it has a compound annual growth rate of just over 10% annually. Once again, that is from a high quality blue chip company and crushes the TSX index, which has only returned approximately 3% annually over the same time period. Another way for young investors to combine income and growth is to not only look at earnings growth, but find those companies that have recently begun to raise the dividend. Case in point, GoEasy. GoEasy recently achieved Canadian Dividend Aristocrat status. It has a 5-year dividend growth streak, over which period it has grown the dividend by approximately 30% annually. This is the second highest dividend growth rate on the TSX index. Over the past 5 years, the company's share price has skyrocketed. It is up 233% and has been a star. Remember, a solid dividend growth investing strategy does not mean you have to sacrifice growth. One is not independent of the other. You can achieve both. Now, let's get to our next question. The next question comes from AVD. The question is, are tech stocks, or ETFs, currently the best investment since they are the most COVID resistant? Well, I would argue that they are not the best investment because they are COVID resistant. I think they make for the best investments because they have, quite frankly, crushed every other industry over the past decade. Let's look at some numbers. The S&P TSX Capped Information Technology Index, which is the bellwether index that tracks the tech industry in Canada, is up by approximately 420% over the past decade. In comparison, the TSX index is only up by approximately 30%. This means that the tech industry has far outperformed the TSX index over the past 10 years. Not surprising. The tech index is home to several high-flying growth stocks, and we've been in a bull market. It's also why the S&P 500 has far outperformed the TSX. In Canada, the technology sector accounts for only 5.5% of the TSX index. Although it's more than double where it was only about a handful of years ago, it is far below the 25% weighting that it holds on the S&P 500. Not surprisingly, the S&P 500 has thus outperformed the TSX index. Another thing that has changed over the past year, and Avi D is correct in that tech has proven to be a defensive position amidst the current pandemic. The shift to work from home has actually accelerated the need for certain technologies. This means that tech is likely to outperform over the near future, and given that adoption rates for several of these softwares, several of these tech innovations, if you will, are still at very low rates, tech is likely to outperform over the next decade. Although valuations are currently stretched, you can still find value in the tech sector, and every portfolio should have exposure to tech. Otherwise, you'll miss out on some pretty significant gains. Let's finish this with one of the most popular questions, what is at the top of everyone's mind, and comes courtesy of Narissa Ongo. The question is, do you think the second crash has started? It's a question that we get asked all the time. The reality is, nobody can answer that question with 100% certainty. However, I do think that last week, investors were rattled. In my last video, I brought to investors' attention that the TSX index entered overbought territory last Monday. Sure enough, the TSX corrected pretty quickly and finished the week down by 4%. In fact, on Thursday, we saw the largest single-day drop since March. Naturally, investors were a little bit nervous. I believe investors have a right to be nervous. In fact, they should exercise caution over the short term. Why? Because the underlying numbers simply don't justify the straight upward shot that the markets have been on since the end of March. For starters, companies are still conserving cash. They are pulling back capex, and they are not spending nearly as much money in the economy. Although the economy is slowly reopening, there are still many individuals who are still in unemployment. This isn't something that's going to turn around overnight. Secondly, most companies have yet to report earnings, which include the full brunt of COVID-19 mitigation efforts. This means that the next set of quarterly results will be much worse than those that were just announced this past quarter. Likewise, the US, Germany, Canada, Japan, several of the G8 companies are officially in recession territory. How long will it last? Nobody knows. We could hit a second wave of COVID-19 or even perhaps a third wave. This might cause several other shutdowns. We just don't know what's going to happen. That's why when someone asks, is a second crash imminent? We don't know. It might be, but it might not. And why might it not be the second crash? Because there's an old saying that says, don't fight the Fed. This means that when the Feds are pumping liquidity into the economy, the markets tend to rise and benefit. We are now seeing an unprecedented amount of liquidity being pumped into the market by federal governments. Not only that, interest rates are at all-time lows. And just last week, the chairman of the Federal Reserve in the US stated that they have no intention of raising rates over the near term. In fact, they will use every tool at their discretion to ensure that the economy rebounds and rebounds quickly. So, with all that being said, it's impossible to know whether or not we are on the verge of a second crash or if we will continue our upwards trend from here. No one really knows. The important thing is to be cautious. And in our opinion, the best way is to stay invested. Don't sell your stocks at the first sign of panic. Average into your position. This will allow you to take advantage of the lows. You may not catch the bottom, but you will come out ahead in the long run. And that brings us to the end of our video. A big thanks to Trevor, Avi, and Narissa for their questions. If we haven't answered yours, don't worry, stay tuned. We plan on doing several more of these Q&A sessions over the next few months. If you have a question for us, please ask it in the comments below. As always, please like the video and subscribe to our channel. We'll hit back at you with more great Canadian content. Until next time.